the main thing in macro assets was watch this triple top in gold. If gold breaks out, that will mark the beginning of a bull market for gold. And as we see the bull market for gold being unleashed, that will unleash other things. And then we saw the copper price doing the same. And then we saw silver doing the same. The thing is, silver is way off from its prior highs. And so if you ask me if this is a real bull market, which I firmly believe it is, then silver is likely in the trajectory of retesting its prior highs.
Gold prices rose by 1% on Wednesday after a surprisingly soft U.S. consumer inflation report, fueling hopes for an interest rate cut in 2024. Investors eagerly anticipate the Federal Reserve's latest policy statement and economic projections. Concurrently, spot silver experienced a notable increase of 3.2%, reaching $30.19 per ounce. Tavi Costa, a partner at Crescat Capital, remarked that gold has recently confirmed a bull market for metals by breaking out of a triple top formation, a technical pattern he had been closely monitoring. This breakout suggests a broader bullish trend across the metals market, with similar upward movements observed in copper and silver. However, despite the recent rally, silver faced resistance at $30.06, which led to a bearish rebound. The price started today with a substantial decline, breaking below $29.30 and settling under this level. This maintains a bearish outlook for the near term, with targets set at $28.55 and potentially extending to $27.65 if the previous support level is breached. Costa pointed out that silver has historically peaked at around $30 in recent years, and its current stabilization within this range is seen as a healthy price pattern. He noted that silver often leads the way in price increases, indicating potential future gains. Despite the positive trends in metal prices, gold miners are experiencing a different level of success. While gold prices have surged by 20% over the past year after a record-breaking rally, a benchmark index for gold mining companies has increased by only half that amount. Costa explained that investors are increasingly perceiving that metal prices can rise without corresponding increases in miners' stocks. However, he emphasized that historically, bull markets in metals have always been accompanied by bull markets in miners. Mining stocks will likely follow suit, with gold already rising, followed by copper and silver. Join us as we delve into TaviCosta's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Silver is taking its break now and likely will move a lot higher. We've had gold breaking now, confirming that we're probably in a bull market for the metal. Once it has been confirmed, which was when we had that triple top on gold, that I was really discussing that. As to me, it was the main thing in macro assets was watch this triple top in gold. If gold breaks out, that will mark the beginning of a bull market for gold. And as we see the bull market for gold being unleashed, that will unleash other things. And then we saw the copper price doing the same. And then we saw silver doing the same. The thing is, silver is way off from its prior highs. And so if you ask me if this is a real bull market, which I firmly believe it is, then silver is likely in the trajectory of retesting its prior highs. And so in my view, that's inevitable as well. And so I'm paying close attention to that because I think we're just consolidating a little bit before we move higher. I mean, remember when we hit 30 in the past 2-3 years or since 2020, those are sort of peak moments for silver prices. And now we've been kind of establishing ourselves here in this 30 range or so, call it, 28 to 30 plus range. And, I do think that that's a healthy price behavior for the metal. If history plays a role here, which always does, I do think that silver is going to lead the way to the upside. And I think it's crazy is that there is this new perception as well by investors that, yes, we're going to see metals lead the way to the upside, but the miners are not going to follow. I don't know anybody who can actually prove that in history that we've ever seen bull markets in metal prices that are not also led and accompanied by a bull market in the miners. And so I think there's a lot of dominoes falling. I don't mean falling in a decline price idea, but really the idea that things are going to move each other. And we have gold already going there, copper is going there, silver is in the process, and the miners are probably the next move ahead. Just use an example. Now, how much did gold price, metal prices, commodities went up in the 70s, okay? But that was an environment that interest rates were rising, and still we had commodity prices rising. We all should agree that if interest rates are rising, although gold and commodities can rise with nominal and real rates rising, it is a negative factor. Why? Because it's creating a different vehicle that is becoming more competitive because interest rates are higher and gold doesn't yield anything. So that makes sense. Now, that doesn't take away the opportunity. And what I think it's going to happen in this environment is that imagine if gold prices and commodities did so well in the 70s with interest rates being allowed to move as high as they did back in those days. Imagine today where interest rates have basically a limit over them. Because if we see interest rates rise too much, things are going to break. We all know this. You don't need to be a genius just to look at how much debt we have. Things are going to break. So the fact that we have, a structurally bullish environment for commodities, and people have massively underallocated, and companies themselves have massively also reduced the amount of capital spending to increase supply, long-term supply of those metals. I mean, this might be the best environment I've ever seen. So when I hear somebody being bearish and telling me, haven't we seen, the prices of the miners over the last 30 years? I don't care what happened in the last 30 years, because what's likely to happen in the next 10 years is nothing like the last 30 years. It's completely opposite. And so to me, that's really where I get excited and why I'm doing what I'm doing.
Tavi Costa believes that the Federal Reserve will focus on underlying weaknesses in the labor market, particularly considering the rising interest payments relative to GDP. The U.S. labor market has cooled from its overheated conditions 2 years ago, Costa noted. However, the Fed still seeks more evidence that inflation is nearing its 2% target before lowering its benchmark interest rate. Fed Chairman Jerome Powell echoed these sentiments during a press conference following the Fed's interest rate announcement. He stated that while the labor market remains strong, it is gradually cooling and rebalancing. Powell emphasized the need for additional signs that inflation is approaching the central bank's goal before any rate cuts are implemented. Costa also highlighted the discrepancy between official and unofficial gold purchase figures. "We only know the official numbers, and the unofficial amounts might be higher," he said. The moves in the gold market over the past 6 months suggest that central banks are likely buying more gold than disclosed, reinforcing the conviction to hold gold. Official data from the People's Bank of China supported Costa's view. After adding to its gold reserves for 18 consecutive months, the holdings were unchanged in May. This unexpected halt in accumulation led to a sharp decline in global spot prices on Friday. Let's get back to the interview.
It's good to see some sort of shakeout in the markets a little bit, and in order to see who's got the high conviction to stay in this long-term trend. I think that's absolutely normal. What we've had on Friday, I think, was an overreaction to different things. The labor data, which to me, in my read, was a lot weaker than what was perceived. I think the only way you can twist that as positive is what's been happening with immigration in terms of the new folks coming into the country, which is one of the largest influx of illegal immigrants we've seen in the history. That's certainly starting to add to the labor force. And I think that the market saw that as very hawkish, potentially very hawkish for the Fed. But knowing that the Fed is in a dilemma with interest payments rising as much as they have been relative to GDP, to me, the Fed is going to play the cards as employment and labor market actually showing a lot more weakness than the markets actually reacted on Friday. And so that to me is the main focus. And I can go on why I think the labor market looks so weak. But essentially, the other thing that also happened on Friday was the news that, people call it as the news that China announced they're going to be stopping to buy more gold. And that wasn't necessarily the announcement. There was no announcement whatsoever. All it was a report that shows the official holdings of China in gold unchanged from the prior month. And that was a total overreaction of people already leading to the conclusion, completely premature in my view, that China announced that they're not going to be buying more gold. I mean, if you look at the the currency itself, the Chinese yuan relative to the dollar, the more it devalues, the more it forces the Chinese government to actually accumulate gold. And we've seen this trend moving, for the prior years or so. And so I believe that the big imbalances we have in the credit market in China, the real estate and other issues in the banks and so forth, only reinforce the reason for folks to own gold. A reminder that China is not the only one buying gold. There's other central banks that have been also buying gold in a big way. And all we know is the official numbers. Who knows about unofficially how much those institutions are really being buying? I think none of us know precisely how much that is, but we know that given the moves that we've seen so far in the gold market over the last 6 months or so, it gives us the conclusion that and conviction to assume that institutions like central banks have been buying a lot more gold than what they have been disclosing.
As we navigate these uncertain economic signals, what will be the next significant move in the metals market, and how will it shape investment strategies in the coming months? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.